Hello, everyone. Thank you for tuning in to part two of the PayPal stock analysis. I think if you want to check out some information about PayPal's business model as well as some of their competitive advantages, please check out part one of this video series. Now we're going to go into part two. So I'll be exploring the macroeconomic factors that may be at play for impacting some of PayPal's short-term revenue and as well as earnings shortfalls, as well as some of the growth opportunities you can look forward to in the future. All right, I'm gonna go share my screen. Perfect. Okay, so let me just make sure it's sharing. All right. Perfect. So here you can see a meme that I brought up of, which was CEOs during economic boom, my profits. CEOs during recession, our losses. I think this is a pretty good meme that sums up what happened in 2021 and 2022. So 2021, I was actually working in tech myself, and there was a lot of optimism in tech companies, but there was so much optimism that a lot of these tech companies weren't actually looking at how much they were spending very much. It's like everything for the sake of growth. So a lot of companies in tech hired a bunch of people in 2021 because they thought that demand was going to go on forever. The pandemic boom was going to last a decade. So they made a bunch of hires and they prioritized growth. And they did actually experience a lot of growth, both in earnings and revenue in 2021. However, 2022 came, and when their profits and revenues started slowing down because the aftermath of the post pandemic boom started coming down, a lot of these tech CEOs were saying, we really shouldn't have hired all that much in 2021, or we shouldn't have spent so much. What are we going to do now? We don't have money. So people in 2022 started being like, okay, we got to cut our losses, get our balance sheet to look good, fire a bunch of people, and really make it the year of efficiency, if you know the reference. And we got to make sure that we get our costs under control. So I think if we just look at some of the companies within the e-commerce space, we can look at Amazon and see that pattern play out. So 2021 June, 27.18% revenue growth. And then the next quarter slows down to 15.26%. And then you can see that it's pretty much slowed down with the exception of 1 year to single digit growth for Amazon. And this is just an indicator of the overall health of the e-commerce space. You look at another company, Shopify, which during the pandemic absolutely exploded. I think this stock went up at least 10x. In March 31st, you can see it grew its revenues 110%, which is insane. But then you can see as the years progress, the revenue growth starts to slow down 56%, 46%, 41%, and to the point where in 2022, it dropped to 15, 20%. Recently, it shot up a little bit, but you can see with Shopify too. Massive revenue growth in 2021 and then a slowdown in 2022. You can see the same with Block. Block is a direct competitor to PayPal in some respects. They're online. They have a solution called Cash App, which is a direct competitor to Venmo. And they also have in-person payment capabilities that they offer to merchants, which is what PayPal offers through iZettle. But here you can see during the pandemic, 143% growth, insanity. And then it tapers down to 26%, 29%, and then it goes into negative revenue growth for 2 whole quarters. And then it seems to be on its way towards recovery now. But this is the pattern that we see with a lot of these tech companies, which is insane growth in 2021. And then they realize that they overhired, they maybe made overly optimistic projections, and then they have to focus on profitability, and their revenue growth slows down, and then slowly as that effect tapers off, they start recovering with both earnings as well as revenue growth. All right, so let's look at net income, which is earnings. It follows a very similar pattern. You can see here in for Amazon, they made a ton of money in 2021, and then just a series of losses, and then they're slowly getting back to their slowly getting back to being profitable again. If you look at Shopify. Um, Again, they were making money in 2021 and then losses, and then a little bit of profit and then more losses as they go back into growth. So, same with Square, profitable during the pandemic, and then after the pandemic, they just had losses upon losses. So, um, a lot of this is really because tech companies thought that this pandemic boom was going to last forever, so they made a bunch of changes to prioritize growth, and then 2022 came and a lot of them were blindsided, and found that they had way too many costs, and they invested in a bunch of stuff that they weren't even able to use because of the slowdown in demand. Now, if we look at other competitors to PayPal, it actually follows a similar story. Now, if you've been following Aiden, which is a European payments company that's a competitor to Stripe as well as Braintree, just this recent quarter, they were expecting this company to do about 40% growth in revenue, and they only achieved 21%. So they massively undershot, and their stock tanked by 39% as a result. You can look at Stripe here as well. Now, Stripe, you can see in 2020 and 2021, massive growth. Revenue grew from 2 billion to 7.4 billion to 12 billion, and only grew just a little bit in 2022. So, growth across tech companies, companies in the e-commerce space, companies in the fintech industry in general have all pretty much experienced stagnation. And when I see people talking about how PayPal's business is slowing, they always point to it to be because of competition. Because Stripe is stealing their market share, or Apple Pay is stealing their market share. But really, when I look at the numbers, um, I recognize the fact that there could be some competition coming in, but it seems to play into that general pattern of tech companies and fintech companies all slowing down in 2022. And I feel like people are being extra hard on PayPal for some reason. In 2021, you can see that PayPal grew their revenue, sorry, about 31%. And the growth slowed down to 19%. And then now it's tapered down to single digit growth. If you look at this pattern, it looks a lot like Amazon, actually. A lot of growth followed by a period where there's still growth, but it's not growing as fast as it used to be. I think PayPal this year is guiding to about 8 to 10% revenue growth, about 20% growth in earnings, which is still good, but it's definitely slowed. But I think looking at some of the other companies in this space, I don't think it's too much out of the ordinary. If you look at their earnings growth, it's a pretty similar story as well. Just actually, I think this slide is wrong. Sorry about that. But if we look at PayPal's earnings growth, it follows a similar pattern, which is they had, I think, around 4 billion or so, or 4 to 5 billion in 2021, and then 2022, I believe it's slowed down to about like it actually dropped significantly to I think about 2 or 3 billion, and then I think it's back to 4 billion to what it used to be. But it's a similar story of earnings compressing during the pandemic. During the post-pandemic phase, and then gradually recovering later on. Okay, so let's talk about the margins and the users. So, a lot of people also point to PayPal's declining margins as evidence that the company is dying. If you look at gross margin, you can see it has fallen from about 50 or so percent to about 40 or so percent. But I think this is because of acquiring other business units. So PayPal's Braintree unit is growing at about 30% per year. And in the last video, I talked about how PayPal is a solution that's more targeted towards enterprise clients where the margins are thinner. So if that business is in hyper growth mode compared to its core checkout business, that's going to lead to its margins going down. Another reason why is Venmo. Venmo is another company that makes up a lot of the total payment volume, but the margins are pretty thin on Venmo because PayPal has yet to really monetize that asset very well. So as PayPal has these growth drivers that are driving the future of the business, it kind of dilutes the margins from their core checkout business, and it's leading to gross margins going down. However, if you look at PayPal's operating margin as well as their net margin, you can see that it's actually pretty stable and even actually is above average in a lot of ways in the recent maybe 2 or 3 quarters. And that's because while PayPal is dealing with margin compression from some of their growth drivers being lower take rate businesses, they're becoming more efficient in how they're able to operate as a business, which means they've cut down on some of the G&A costs, and they've also done initiatives where they're using AI to make it so that coders are more efficient when they code for PayPal. So here, if you look at it, I don't think this negative sentiment when it comes to margins is necessarily super justified. And I don't think people are giving PayPal the credit that's due for their business operating more efficiently. Another reason that people point to as to why PayPal is stagnating is they point to the negative growth or the stagnant growth in users. And if you look at here, Q1 of 2022, they had about 429 million users. And right now it's only about 431 million users. So the user growth has definitely slowed down. However, I chalk this up to 2022 being the year of efficiency for a lot of companies. And they discuss this in the earnings call where PayPal goes into their users. They find users that only transact once a month or once every 2 months, and they only do it when they're offered some kind of incentive. So PayPal's realized that some of these users may have been people from the pandemic year when PayPal was investing so much money in growth. Now that they have to prioritize efficiency in 2022, they're actually making a priority to shed some of these users that are not driving much earnings or much profit for the business. However, if you look at this trend, you can see that during that time when users were stagnating, PayPal has actually been increasing the average number of transactions per user from 47 in Q1 of 2022 to Q2 of 2023 being 54.7. So they're still able to pull levers in order to get more engagement from their existing users. And I think this is pretty normal for a tech company to be doing, which is in 2021, all the tech companies were prioritizing insane growth. Now PayPal is still prioritizing growth, but they're trying to do it in a way that is most cost effective. And the strategy that they've used is to increase the number of transactions rather than the number of users and to operate in a more lean way as a result. Now, let me go into some of PayPal's growth drivers. So the first one is PayPal Complete Payments. I think may have touched upon this briefly in the previous presentation, but PayPal as a way to spur further growth, because 2022 was kind of a recovery year. 2022, 2023, moving into 2024, if the economy improves, PayPal is looking looking for drivers in order to increase both revenue as well as earnings. And one of these is the PayPal Complete Payment solution. This is a solution that's more targeted towards small businesses, and it's designed to be the leading way for small businesses to accept payments. The whole idea behind this is if you give consumers their preferred method of payment, they're more likely to make a purchase. So here, PayPal's original value proposition to small businesses was if they see a PayPal checkout button, then they're more likely to convert because people who use PayPal are more comfortable with using PayPal. They know that their money is going to be safe when they make the transaction, but they've added that value proposition to include multiple options, including integrating their buy now, pay later solution, along with being able to check out with Venmo, and they've even integrated Apple Pay as well, which is a popular way for Apple users to make purchases online. And they've, according to the earnings calls, they've actually had a lot of really good traction with this offering. And this is their strategy to be able to capture more of the small business market share in order to then get transaction volumes that they typically have a high take rate for. The buy now, pay later solution for PayPal is also growing very rapidly. I think is the compared to 2020, the total payment volumes 3x or 4x, and the overall buy now, pay later industry is projected by Grandview Projects to grow at about 26.1% each year. And PayPal, that's another growth avenue for PayPal, which is actually integrated into their complete payment solution. And credit to where credit's due, PayPal has done a really good job of growing this internally. Rather than acquiring another buy now pay later solution, they were able to create this organically to the point now in 2023 where they're one of the top 2 or top 3 leading buy now pay later solution providers. And recently they've actually been able to offload a lot of the credit risks associated with this to KKR. So this shows their ability to leverage buy now pay later as a way to grow themselves, but also not be so bogged down by having a ton of loans on their balance sheet. Because with that recent KKR transaction, if that is something that continues in the future, it could mean good things for PayPal down the road, where they're able to still remain pretty nimble. The next thing I want to talk about is Venmo. Now, this is a really, really good asset on PayPal side. But you can see here, there's still a lot of opportunities in the future to be able to monetize Venmo. You can see with Cash App, there's 51 million users, so Venmo has twice the number of users as Cash App, but they're a lot less efficient at monetizing. You can see here their revenue that they made was about $935 million in 2022, but it's actually projected to more than double in 2023. And for Cash App, the amount of revenue they generate is, even though they have half the users, is $10.6 billion and projected to grow to about 14 billion in 2023. Cash App is profitable. It's making them about $3 or $4 billion of profit, which is actually really, really significant. While for Venmo, it's I don't know, it's probably not making them a lot of money. So the thesis here is if the new management team is able to successfully monetize Venmo to become similar to Cash App, then PayPal could see a lot of growth both in their earnings as well as their revenue. And they're definitely going in the right direction because Cash App makes a lot of their money from cryptocurrency, from people going on Cash App and buying Bitcoin. Also, a lot of their money is made from their credit cards, cash cards, as well as instant settlement and transaction fees. Now, PayPal is trying to go in a similar direction in order to monetize Venmo. Other than having Venmo being accepted as a payment method, they're also trying to introduce their own cash cards. They're also introducing cryptocurrency investing with Venmo, and it's still yet to be seen how successful these efforts are. But if the management team is able to get Venmo to become similar in profit as well as revenue to Cash App, it could mean huge things for the business. Now, Braintree is another area of PayPal that I think has huge potential. It's already being used by a lot of enterprise companies like Uber, Spotify, Airbnb. One of the things that really struck out to me in the earnings call is Dan Schulman when he was being interviewed by Goldman Sachs. He mentioned that Braintree actually stacks up really well against the competitors Adyen as well as Stripe, because what he mentioned is about 20% of Braintree checkout goes through the core PayPal checkout solution, while 80% actually go through credit cards. But when it comes to credit and debit cards, PayPal's authorization rate is 85% versus 65% because they have a lot more data than their competitors. And having this competitive advantage compared to Adyen as well as Stripe really gives Braintree a lot of leeway to grow in the future. And if they can sign more enterprise clients, this is a massive growth driver for PayPal. Another really important thing was Braintree is because they're getting more richer data sets from a lot of these big enterprise companies that have a lot of transaction volume. It's able to increase the quality of their branded checkout, because then they can use those quality data sets that they're getting in order to use AI to then improve the authorization and loss rates of their core checkout business that they're offering to small businesses. So in one stroke, Braintree is a good growth driver for PayPal, but also it's able to improve the products of PayPal as well, which drives more growth for those other offerings in the future. So this is pretty important as an asset. I think they've also mentioned that Braintree generates pipeline for smaller merchants. So say PayPal signs a big merchant like Airbnb or DoorDash, and they have a lot of partners that are smaller companies, then PayPal can then offer the core checkout solution to them, which is a lot higher margin for PayPal. So Braintree is a really important asset for PayPal, and I think it should justify having a higher valuation than, I think, 12 times earnings for PayPal. Now, let's go into some of the other bets or other growth drivers for PayPal down the line that are a little bit more kind of long shots, but if they manage to pull it off, it could be huge for PayPal. Let's go over PayPal Ventures first. So PayPal is has a venture capital group that goes after different startups, and Paydi was actually one of those startups that PayPal invested through this venture capital arm. But any of those ventures could turn into something. And PayPal also is invested in both Uber and Mercado Libre. So if those companies do well, it does well for PayPal also. Paydi is another really good solution that could drive growth for PayPal, because Paydi is a leading buy now pay later solution within Japan. So if this offering for PayPal grows, it increases the number of transactions that flow through PayPal, and then PayPal can grow their cross-border business with Japan. If Japanese consumers want to shop online for let's just say US based or UK based companies, then PayPal is going to be that payment solution provider that can facilitate both buy now pay later purchases, but also just purchases in general. And cross-border payments are a really high margin business for PayPal. Another area that PayPal can go into is China with their GoPay ownership. If once the Chinese economy recovers, which hopefully they do soon, then PayPal is able to then take advantage of the demand for Western goods, and they're also able to facilitate those cross-border transactions. Zettle by PayPal is something that I think is an overlooked asset. I don't think I've seen anybody talk about this as well. But with Alex Chriss being the head of small business and self-employed division added to it, I think he might look into iZettle and see if he can make something out of it. Right now, it only makes up about 1% of PayPal's revenue, but if PayPal is able to offer iZettle as a way for a lot of their merchants to be able to accept, let's just say, QR code based payments or in-store payments, this could be a really strong competitor to Square. And if they're able to utilize those powerful data sets that they have with all their different solutions, they could really make iZettle be something that's really powerful as a growth driver. Another thing that can drive future growth is cryptocurrency. And PayPal recently launched their PayPal stablecoin. To be honest, I have no idea how this drives growth in the future, but stablecoin could be a good way to send money quickly and overseas. And if they're able to control that market because they've already gotten a lot of regulatory approvals, and if PayPal ends up being the way that boomers are comfortable with using cryptocurrency, that could be a pretty lucrative business because then they can get the transaction fees as well as the commissions from people taking their money and converting it into PayPal stable currency. So a lot of these are kind of high level long shots, but I think with good management execution, it's possible that one or two of these could pay off in a significant way in the long run. So let's go into analysis of management. So how good has management done since PayPal has been spun out in 2015? So let's go over the good things first, because I've seen videos where people just are absolutely dunking on management, which I don't think is very fair. I think PayPal's management actually is actually doing has done more good than bad over the past 8 years. So one of the successes of management is being able to diversify their business from eBay. Now, eBay made up, I think, about 1/3 of their total revenues and around 20% or so of earnings, if I'm not mistaken. And they were able to diversify from eBay while growing at like 15-20% over the past 8 years, which is not an easy thing to do. One company I'm looking at is actually C Limited, where they have three divisions: a gaming unit, a e-commerce unit, and a payment unit. And that gaming business is really dragging down the rest of the other units because it's been declining slowly. But with PayPal, being able to divest from eBay while continuing to grow their earnings and revenues in a way that justified a 30 times earnings for the past 5 years or so, is not an easy task, and it shows a management that is able to really move quickly and execute in a good way. Over the past 8 years, PayPal's revenue has 3x, total payment volume 5x, EPS 4x, and users more than 2x. So this is not easy to do as well. And PayPal has transformed itself from a business that was very closely tied to eBay and was still able to grow all of these key metrics well over the past, let's just say, 5 to 8 years. Now, buy now, pay later, I think, is a huge win for management. PayPal could have spent billions of dollars acquiring another buy now, pay later solution, but they were able to develop one internally, create partners with companies like KKR to offload a lot of the credit risk. And right now, PayPal is at least top 3 when it comes to buy now, pay later solutions, and they were able to capitalize on that trend for an industry that's growing very rapidly. I think they've made some good acquisitions as well. If you look at Braintree and Venmo, maybe Honey, I don't know how well Honey will play in the long run, but certainly Braintree and Venmo were both acquired for, I think, in total, because Braintree, I think, owned Venmo at the time. So PayPal acquired this for under $1 billion. And right now, it's one of the most powerful, valuable assets under the PayPal umbrella. I think that acquisition was a very solid acquisition. PayPal has grown their partners a lot over the past 5 to 8 years. They've made partnerships with a lot of banks by providing users with the option to choose how they want to fund their PayPal account, where before PayPal was seen as a rival to a lot of these banks. So I think that's an improvement as well. And I think the $5 billion buyback program is pretty significant, because if you go over just the previous presentation where I was doing some discounted cash flow, they don't to be 30 or 40% undervalued. They only need to achieve, let's just say, a 5% earnings growth over the next 5 years and 2.5% in the next 5 years following that. They can achieve that by simply just taking their earnings and buying back their own stock. 5% of their market cap, which is around 60 billion. So 5 billion of that is pretty significant when you think about how much this is going to improve their earnings per share. Now, it's not all fun and games, or it's not all roses here. I think management did a few things that maybe we can question them on. One of them is Venmo. I think they've done a good job of increasing the number of users for sure, but they still have to hit that magic button of monetizing Venmo as well as Cash App. And if they're able to monetize it even half as well, I think it's a massive win for PayPal, both in terms of earnings as well as revenue growth. Now, one of the reasons why PayPal has been punished so much is that in 2021, I was watching their Investor Day presentation, and they gave some really rosy guidance about how users are going to go to 700, 800 million in the next 5 years, and earnings growth and revenue is going to be at 20%. So they were a little bit too rosy. And then when they weren't able to hit those expectations, they're only able to grow at 10% or so. Investors kind of lost their patience with PayPal, and that's the reason, I think, for a lot of the negative sentiment here. But I don't think it's right to fault PayPal too much for this, just because every single tech company was making this mistake. Whether or not they said it in their earnings call or they didn't say it, they all acted like growth was going to go forever, and then when it didn't go forever, everybody ended up scrambling. So another thing with management to note is there's not much insider ownership. I think insiders own maybe less than 1% of PayPal overall. Certainly PayPal makes up a large part of Dan Schulman's net worth, but he doesn't own it's not like a founder-led business like Meta, for example. So there is that to consider. PayPal has kind of dropped the ball on some of their acquisitions in the past. I think Zong and TO Networks were basically just write-offs for them. And another thing that PayPal I don't think is doing too well is PayPal has a really powerful brand that appeals to everybody, unlike Apple Pay, which only appeals to Apple users. PayPal has that brand, but if they go into areas that they're not supposed to be in, like politics and things like that, that can damage the PayPal brand, and it could be bad for business. That's all I'm going to say here. Now, it would not be prudent for us to go through this presentation without mentioning the fact that PayPal has gotten a new CEO. Based on everything that people have said about him, and he still has to prove himself, but he seems to have a pretty solid resume. He was the head of the small business and self-employed group at Intuit, compounded customers and revenue by 20%, 23%. He's also done really well in facilitating acquisitions. So he helped with the $12 billion acquisition of MailChimp. And I think this is a good mesh for PayPal, because PayPal has historically grown through acquisition, and I think they wanted to bring somebody who has that level of experience so they can continue to make good acquisitions to grow their business. Just don't acquire Pinterest, please. Okay, well, so this is the end of the presentation. My verdict on PayPal is it's not like a spectacular business. Like, it's not like Google, or it's not like Visa or MasterCard, where um, I don't even know if I should put Google here, just because of all these challenges that they've had through their business through ChatGPT, let's just say. But there's certain businesses out there like McDonald's, let's just say, where you can just sit back, kick your feet up, and get a monkey to run the business, and it's still going to do well. I don't think PayPal's in that camp, because they do have a lot of competition that they have to deal with. I acknowledge that. However, they do have competitive advantages. I think they have the scale advantage, the brand advantage, the data advantage, and as well as powerful network effects that they can leverage. But they have to execute in a good way. They have really powerful assets. I think PayPal Complete Payments has a lot of potential. Venmo and Braintree, especially Venmo, have a lot of potential to drive more revenue and earnings, although it also requires good execution in order to become successful. But the way that PayPal is currently valued, which is under $60, management doesn't have to hit a home run. They just have to maybe hit the ball to second base or so, or even first base. And that could mean, the stock being 50% undervalued from where it currently is, because $60 or below $60, I think it's like $57 today, isn't pricing in much growth at all. And they're able to hit even just a small conservative earnings growth just through their $5 billion buyback strategy. If they continue down that path, they don't even have to necessarily execute very well at all. They could just keep buying back their own shares, and that would be able to justify their current valuation. So my verdict on this is it's kind of a low risk play, because if PayPal, the only way you lose money on this investment is if PayPal absolutely just, I don't know, just shits the bed completely, and they let their business get completely overrun by competitors. If they're even able to maintain their current status and with buybacks, I think this could be a pretty decent investment. But if even one of their growth plays ends up playing out, like their stable coin bet, or their Braintree continues to deliver value, or Venmo suddenly gets monetized the same way as Cash App, you could see a 2x, 3x easy on this stock. So I think it's a compelling opportunity. Thank you for letting me share this today with you guys. This is part 2 of the PayPal stock analysis. Please like, comment, subscribe. Let me know what kind of company you want me to cover next. And remember, this is not financial advice. Wink, wink. All right. Thanks so much. Take care. Bye.